first. You have the charts. You have the numbers. You have the newsprint delivered to your door every morning. You have the ticker spitting out prices faster than you can record them. You have everything required to formulate a winning premise. You are failing because you lack control. The market is not testing your intelligence. It is testing your nerves. It tests your patience. It tests your character. It tests your self-mastery. The tape knows your weaknesses. It finds them. It exploits them. If you want the fortune this great game offers, you must first master the fortress of your own mind. Discipline is not a suggestion. It is not an option. It is the entire margin of profit between the professional speculator and the reckless gambler. It is everything. I have lost millions. I have made millions. I have learned that the losses were never caused by the market. They were caused by my own human frailties. They were caused by the lack of discipline. I share this not to entertain you, but to save you from the errors that nearly ruined me. Pay close attention. Subscribe now, like this video, and leave a comment. By doing that, you help more people see this message. And you let me know this work is not in vain. The financial penalties incurred by poor discipline constitute the steepest education cost in the market. To dramatically lower this price of entry, one must study the foundational text where the greatest lessons were codified. In 1923, the financial journalist Edwin Lefebvre recorded the principles and hard-won wisdom of the great Jesse Livermore in his book, Reminiscences of a Stock Operator. This text serves as the ultimate training ground for the serious operator, allowing you to absorb decades of catastrophic errors and brilliant insights without incurring the market's punitive fees on your own capital. However, to translate the environment of 1923 into the context of today's complex systems, the Max Davidson annotated edition is critical, offering essential commentary and historical bridge building necessary for the modern student. A link to this essential edition is provided in the description below. Let us begin. The foundation of professional speculation is mechanical execution. Discipline is not about having an iron will. That sounds romantic. It sounds like struggle. It is wrong. Discipline is about automating your decisions. It is about removing the will entirely. The will is weak. The will is inconsistent. The will is subject to anxiety after a loss and arrogance after a gain. Profitability begins the moment you remove subjective feeling, hope, fear, greed from objective rules. The rules must exist. They must be written down. They must be unambiguous. When your system, your analysis, your tape reading tells you the condition for entry is met, you must enter. Instantly. You do not pause. You do not second guess. You do not worry about the price being 1/8 higher than you hoped. The price is the price. The signal is the signal. Discipline means that if the rule says exit, the action must be instantaneous and devoid of internal negotiation. The moment you begin arguing with the chart, you are lost. The moment you decide to wait just 5 more minutes to see if it turns around, you are no longer a speculator. You are a hopeful fool. I have seen men ruin themselves in the span of an hour because they allowed their minds to replace the mechanism. They had the right signal, they had the right stop-loss. But the little voice inside them, that whispering coward of ego and wishful thinking, said, "Wait, not yet. It's coming back." Discipline is the act of replacing the mind with the mechanism. It is the refusal to allow emotion to pollute execution. You are not paid to think after the signal arrives. You are paid to analyze before you place the commitment. Once the game is underway, you are simply a machine that follows orders. Be a machine, be cold, be predictable in your execution. That is mechanical discipline. It is the first lesson. The second lesson is the cost of impatience. The premium on waiting. Impatience is the undisciplined urge to do something. It is the trader's internal restlessness. You sit there. The market is consolidating. It is drifting. The tape is muddy. There is no clear direction. The impatient man feels he is failing if he is not placing an order. He feels he is wasting his time. He equates activity with profitability. This is a disastrous misunderstanding of the game. I lost great fortunes early in my career by jumping in before the setup was confirmed. I was eager. I had capital. I wanted to start accumulating shares immediately. I would anticipate the move. I would enter too early. The market would then move sideways or gently against me, draining my patience and my margin through small fluctuations. I would then become frustrated. I would exit the position, often at a small loss, just moments before the genuine movement, the clear break, actually began. Discipline dictates that waiting for the clear sign, the point of least resistance, is a trade itself. It is the most profitable trade you can make when the tape is murky. You are being paid to wait. You must view the ability to sit on your hands, sometimes for days, sometimes for weeks, as capital preservation, as a successful maneuver. Your goal is not to trade often, it is to trade correctly. If you execute 10 trades in a month and 9 are failures because you jumped the gun, you have ruined yourself. If you execute 1 trade in 3 months and that 1 trade is perfectly timed on the clear signal, your fortune is made. The profit made from waiting is often greater than the profit made from rushing. Waiting means your capital is protected. Waiting means your margin is whole. Waiting means you enter the position when the probabilities are overwhelmingly in your favor, when the move has already begun and is announcing itself plainly. Patience is not idleness. It is calculation. It is the discipline to wait for the certainty of the movement. Now, we turn to the market's greatest poison. Hope. The most critical failure of discipline is allowing a losing position to be fueled by hope. I have known this poison intimately. I have held positions that were clearly turning against me, positions that broke support, that signaled a fundamental reversal, and yet I clung to them. Why? Because I did not want to realize the loss. I did not want to admit I was wrong. My ego whispered that the market owed me a recovery. So I held. I waited for the miraculous bounce. I prayed for a reversal that would bring the price back to my entry point so I could scratch the trade and feel smart again. The disciplined trader recognizes error immediately. He cuts the position. He takes the predefined small loss. He moves on to the next opportunity, his capital intact. The undisciplined man holds on. He hopes. He allows a small loss, a perfectly acceptable operational cost, to metastasize into an account-killing catastrophe. Hope is a necessary virtue in life. It is fatal in the market. If you are hoping, you are gambling. You are no longer speculating. You must establish, before you ever commit capital, the exact point at which your premise is proven false. That point is your stop-loss. That point is your boundary. When the price touches that boundary, you exit. There must be no emotion, no discussion, no hesitation. Discipline ensures small losses remain small. Undisciplined hope ensures small losses destroy you entirely. Never forget this rule. When you are wrong, you are wrong. Get out. Wait for the market to prove that you are right before you commit again. Discipline applies first and foremost to risk management. This is the iron rule of position sizing. Over-leveraging or staking too much on a single conviction is the ultimate breakdown of self-control. I see men who have followed the tape, who have done the analysis, who have waited patiently for the clear signal. They have done everything right up to the point of commitment. Then, they ruin it. They feel so certain of the move, they have such conviction that they buy more shares than prudence allows. They utilize all their available margin. They risk 50% of their capital on a single bet. They commit financial suicide in the name of confidence. True discipline demands that you never place the viability of your entire trading career in the hands of a single market move. Never. The market can produce the unexpected. A cable breaks, a headline bursts, a central bank acts unexpectedly. A panic takes hold. If you are over-leveraged, that unexpected shift, that one sudden violent fluctuation, will wipe you out completely. It does not matter if you were ultimately right about the direction of the trend 6 months later. If you are wiped out, you cannot play. You cannot profit. Your primary objective is survival. You must determine the total capital you are willing to expose to the market. Then you must determine the maximum percentage of that capital you will risk on any one trade. I speak of 1% or 2%, not 20%, not 50%. When you risk too much, your judgment is compromised. You can no longer be objective. The size of the risk transforms a clear-headed speculator into a terrified gambler who stares at the tape, paralyzed, unable to execute the stop-loss when it arrives. Never risk the ship on one sail. Discipline is the mathematical restraint that ensures that a loss, even a significant one, is never fatal. It takes far greater discipline to manage success than it does to manage failure. This is the great paradox of the market. It is the arrogance of the winning streak. When you lose, you are cautious, you are meticulous, you follow every rule, you check the tape 3 times, you honor your stop-loss rigidly, you respect the market's power. Then you begin to win. 1 success, 2, 5 in a row. You're making money hand over fist. A fatal state begins to take hold. Arrogance. You begin to believe you are special. You believe you have cracked the code. You believe your judgment is superior to the rules. This success causes the trader to abandon the very rules and caution that created the success in the first place. He increases his position size recklessly. He says, "This stock always comes back." He starts anticipating the market instead of following it. He takes bigger risks. He gets sloppy. This is the fastest path to ruin. The market has a cold, cruel habit of reminding the arrogant man of his insignificance, usually by handing him a large, devastating loss that wipes out the accumulated profits of months. Discipline ensures that the 10th trade after 9 successes is treated with the same cold, methodical caution as the very first. You must not allow success to inflate your ego. You must not confuse a successful run with genius, and it was not genius, it was the correct, patient application of mechanical rules. You must hold fast to your position sizing even when the profits are pouring in. You must maintain your stop-loss discipline even when you feel you are infallible. Treat every new commitment as if you were fresh to the game, with everything to prove and nothing to rely upon but your cold analysis. That is the discipline required to keep the profits you have made. We must also speak of the discipline of observation, the discipline of doing nothing. One of the most profitable disciplines I ever acquired was the ability to sit still when the market was indecisive or unclear. The amateur feels compelled to be involved. He must be short or he must be long. He must have action. If he is sitting on cash, he feels idle. He feels guilty. He feels like he is missing opportunities. This is the noise of the undisciplined mind. The professional understands that sometimes the only disciplined position is cash. Cash is a position. It is the position of maximum optionality. It is the position of zero risk. If the tape is contradictory, if the sector is murky, if the general list is drifting aimlessly, your discipline must be to stand aside. You are waiting for clarity. You are preserving ammunition. Never force a trade. If you must argue yourself into a position, you should not be in that position. The best trades, the ones that make the fortunes, require no argument. They announce themselves clearly. They break the line of least resistance with violence and conviction. When you are uncertain, your discipline must be to stand aside. Watch the tape, read the movements, learn, but do not commit capital. Patience is the greatest form of market observation. Do not allow the need for entertainment to drain your account. Now, let us discuss how to treat the other side of the ledger. Profit. This is the discipline required for scaling out. Undisciplined profit-taking leads to two equally destructive outcomes. First, taking minuscule profits too early. The market moves in your favor. You realize you have a profit, and the sheer fear of that profit vanishing causes you to liquidate the entire position instantly. You scalp pennies. You miss the trends that build fortunes. Second, holding far too long out of greed. The market runs dramatically. You are a genius. You refuse to sell a single share, believing it must run forever. You grow greedy. The inevitable correction comes, and you watch 80% of your unrealized profit evaporate before you panic and sell at the low. Discipline requires method. It involves methodical scaling out, taking partial profits at logical, predetermined resistance levels. You must establish these levels before you enter the trade, just as you establish the stop loss. When the price hits your first target, you sell a quarter of your position. What does this achieve? And it secures capital. It pays for the costs of the trade. It locks in a gain, transforming potential into realized wealth. Crucially, it eliminates the emotional urgency to cash out completely. By taking a partial profit, you have satisfied the internal craving for certainty. The remaining position can now run free. You are playing with the market's money. You are no longer emotionally invested in the entire stake. This discipline allows you to ride the big moves because a significant portion of the profit is already sitting safely in your account. Scale in, scale out. Never liquidate the entire position until the market itself gives the clear signal that the trend is broken. Honor the stop loss. This is not negotiable. This is a contract. A stop loss is the mechanical representation of your financial discipline. It is the pre-signed warrant of defeat. It must be set before the trade is executed. It is part of the commitment price. You must know exactly what you are willing to lose before you even know what you might gain. Once the commitment is made, the stop loss must be honored without exception. Regardless of what the price action looks like when it triggers, regardless of how fast the tape is running, regardless of the news announcement that caused the sudden drop, when the stop is hit, you exit. The greatest psychological error a speculator can make is to move the stop loss further away, even by a small fraction, in the heat of the moment. To move a stop loss is to discard your self-control in favor of fear. You are saying, I will gamble a bit more, just in case. This destroys your capital, it destroys your methodology. Most importantly, it destroys your credibility with yourself. If you cannot honor your own rules, you have no rules, you have only impulse. I repeat, do not negotiate with the market on a losing position. The moment you move your stop, you are telling yourself that prudence does not matter. This act of indiscipline guarantees that your next mistake will be larger, and the one after that will be fatal. The stop loss is sacred. Treat it as a non-negotiable contract between you and your own solvency. Discipline means adhering strictly to your own methodology and analysis, regardless of what the crowd is screaming. You must ignore the public opinion and market hype. Fortune is found in isolation. It is found in the quiet room where you read the tape, where you analyze the charts, where you formulate a premise based on fact, not feeling. The undisciplined trader is always swayed by headlines, tips, and consensus. He reads the financial pages and sees that everyone is raving about a certain stock, and he rushes to buy. He is entering a position just as the smart money, the disciplined professionals, are exiting. If everyone knows a stock is going up, who is left to buy it? The market does not reward consensus. It rewards independent thought and disciplined action. Do not listen to the men on the curb. Do not listen to the broker's tips. Do not listen to your friends who promise easy money. They are all undisciplined. They are all chasing excitement. They are all going to be ruined. Your discipline is to trust your tape reading, to trust your signals, to trust your quantified methodology, even when the noise of the world tells you that you are wrong. If you have done the work, stand by the work. If the trend has broken, exit, regardless of what the front page of the morning paper claims. Never outsource your conviction to the collective fear or greed of the masses. Finally, the greatest discipline of all, consistency over the home run bet. The disciplined path to fortune is through consistent, repeatable application of rules, leading to compounding, measured gains. You are seeking 2% gains, 5% gains, 10% gains over and over consistently year after year. These gains accumulate, they compound. They become vast, not through sudden miracles, but through relentless repetition. The undisciplined path chases the grand slam, the quick 10 times return, the stock that doubles in a week. This mentality leads to reckless risk, over-leveraging, ignoring stops, and chasing rumors. It is the gambler's mentality. The man who seeks the grand slam often risks everything on that one big throw. And when he fails, he has nothing left to compound. Discipline prioritizes long-term survival and mechanical accumulation over the high-risk emotional gamble. You must think in terms of decades, not days. You must treat your capital like a precious, irreplaceable resource. You must be satisfied with the slow, sure building process. The speculator who seeks a 30% return every year, year after year, will ultimately own the fortune. The speculator who seeks a 300% return in a month will ultimately own only the wreckage of his former account. Fortune belongs to the tortoise, not the hare. It belongs to the man who respects the mathematics of compounding and the necessity of strict mechanical discipline. The market is a mirror. It does not reflect your intelligence. It reflects your self-mastery. Discipline is not merely a market tool. It is a life habit that you apply to the market. If you cannot control yourself outside of the trading session, you will certainly not control yourself when the tape is running fast and the stakes are high. You must conquer the urges to rush, to hope, to overcommit, and to become arrogant. Stop chasing easy money. It does not exist. Start building controlled, compounding fortune. Go now and prove that you have the discipline to be rich. The market waits for those who have mastered themselves. It ruins all the others. Go, execute, be consistent, be mechanical, be profitable,